The State of Crypto is presented by Tron, connecting the world to the power of cryptocurrency.
If crypto legislation in the U.S. remains lacking, it could make the country, quote, comparatively less attractive for both firms and investors, according to a recent report from Moody's Investor Service. Joining us now to discuss is Moody's Investor Service SVP for DeFi and digital assets, Rajeev Bamra. Welcome to the show, Rajeev.
Good morning. Delighted to be here.
All right, let's talk about this report. Earlier this month, Congressman Patrick McHenry and Glenn Thompson released a draft bill that gives a blueprint for digital assets that begin as securities to eventually be regulated as commodities. What's your outlook on the market structure bill?
So the proposed bill seeks to clarify the regulatory roles of the SEC and the CFTC in overseeing digital assets, which is an essential move to resolve contradictions that have come up between regulatory agencies in both the state and federal levels regarding whether certain digital assets should be classified as securities or commodities. So the recent actions that were taken against digital asset service providers have further underscored the need for clear and unified guidelines, and recognizing the potential negative impact of regulatory inconsistencies on the markets and digital asset development. Members of the committee are actively advocating for congressional action to provide the much needed clarity for the digital ecosystem.
Do you think it's a long shot for Democrats to agree to it?
There is a need for, and I think there is an agreement on the importance of consumer protection and a harmonized framework. So though differing perspectives exist on the best approach to achieve these goals, hopefully we will see some kind of bipartisan agreement go on the line.
Yeah, we've gone over a decade without this legislation in place, and we've seemed to come pretty far with crypto. Why? Is this more about, I want to say, financial institutions adopting it rather than the technology itself from progressing?
Well, we have seen digital infrastructure develop in the past few years or in the past decade, and also the evolution of new market products. These legislations aim to regulate stablecoins in particular, along with other digital assets, and designed to establish a comprehensive framework for the digital assets ecosystem, just like we are seeing in other jurisdictions across the globe. So the recent investigations and regulatory actions highlight the importance of compliance and risk controls in the digital finance ecosystem, and it underscores the pressing concern policymakers have regarding digital assets. So, however, the lack of bipartisan agreement and progress on digital assets specific legislation may diminish the attractiveness of the United States for firms and investors, especially considering the advancement of comprehensive rules in other jurisdictions and the migration of resources to more accommodating laws. And that's why the priority of having a digital asset specific regulation in the US at the moment.
But I guess my question here is this, is that if you do have these, whenever you have regulation, you have winners and losers. You have people who will benefit and people who won't, people who will be punished. And essentially, I guess my question here is this. We're seeing now the SEC kind of going after people for securities, for trading securities. But of course, there are those who would argue that centralized exchanges are not in the spirit of what cryptocurrencies are supposed to be about anyway, which is an alternative financial system rather than a way for large financial institutions to do their business with higher profit. So I guess my question here is, what kind of development are we talking about? Is it the development of cryptocurrency ecosystems on their own and to develop as they would naturally, or is it about helping? Bless you. I can make that people sneeze. Or is it about helping the large financial institutions get into crypto without, while keeping their mandate from the federal government?
From what we read and in the market structure bill specifically, and the research we are doing, it looks like the regulations are kind of, or the framework will highlight the how the existing regulations apply and impact the growing digital finance ecosystem. And besides that, the need for more stringent regulation in terms of stable coins and digital assets, and the financial structure they have, how would that apply to the existing regulations, and following that, the need for new regulations or new framework in place for digital assets would follow.
You know, Moody's talks about the key division between Democrats and Republicans being over the role of state regulators. Can you talk to us about why that's significant?
It is worth noting that in the past few years, there have been numerous bills addressing digital finance in the US, indicating the increasing attention given to the sector. The diverse range of perspectives among lawmakers, both Democrats and Republicans on both sides of the aisle, reflects the complexity of the issues at hand, particularly regarding whether federal or state entities should oversee the regulation of digital assets, particularly stable coins. However, at the heart of all these discussions, we see a shared commitment to ensure consumer protection and fostering a secure and thriving digital assets ecosystem. But it is important to have a constructive dialogue and work towards finding common ground.
Yeah, you just mentioned stablecoins. I'd love to hear what you make of Federal Reserve Chair Jerome Powell arguing for the need for strong central bank oversight when it comes to stablecoins.
Yes, so the draft framework of stablecoins that we see being debated upon by Chair McHenry has proposed that state regulators should supervise issuers instead of the Federal Reserve. However, this approach of differentiating between bank and non-bank issuers at the state and federal levels could result in regulatory fragmentation and risk disparities. It may also lead to varying sets of rules for different issuers, potentially increasing regulatory arbitrage and compromising consumer protection. However, this aspect of McHenry's draft has been debated by the Waters bill, or the 74-page text of the Waters bill, to strictly prohibit the commingling of customer assets with those of the companies behind digital wallets. And that's why the need for more enhanced regulation and more defined regulation for stablecoins is important.
Rajeev, thank you very much for joining us this morning.
Thank you, and glad to be here.
Great. Have a great weekend. That was Moody's Investor Service SVP for DeFi and Digital Assets, Rajeev Bamra.